SoFi is sitting at $19.60, bouncing off roughly $19.10 for the second straight week. Options traders are loading up into the February 20th expiration with a plus or minus $1.50 expected move. And this entire is that the bottom debate gets tested this week. Welcome back to Fintech Spy, where we turn suspicious calm into a full investigative documentary. I am not a financial advisor. This is not financial advice. And if you're making real trades based on a parody YouTube segment, please reconsider your life choices. This is entertainment, market commentary, and group therapy for people who voluntarily stare at candlesticks. Now here's the real question. Did SoFi find a bottom, or did buyers just temporarily run out of fear? Before we dive into the charts, quick housekeeping. Sorry for missing the midweek review. That head cold going around decided I needed to experience oversold conditions personally, which actually brings up something I want your take on early. Would you rather keep the midweek review or pivot to a deeper dive episode revisiting all the recent news releases and measuring their actual impact on the company? Drop a comment below. I'm genuinely considering restructuring that part of the channel. And second, do you trust $19? Because structurally, something interesting is happening here. We didn't reverse. We didn't explode higher. But we've now defended the same weekly low area around $19.10, 2 weeks in a row. That doesn't scream strength. It whispers stabilization. And stabilization is how bottoms start forming. Analyst land is still quiet. No new additions, no dramatic upgrades, no public panic. The average price target remains $25.98, which is more than $5 above where we're currently trading. So while price is hanging out in the teens, the streets models still live in the mid-20s. That disconnect doesn't guarantee upside, but it does mean expectations aren't collapsing with price. Sometimes silence isn't bearish. Sometimes it's just waiting. Now on the news side, this is where it gets interesting, and honestly, kind of exciting. NerdWallet ranked SoFi as the 2026 best bank and also the best checking account for February 2026. That's not a meme headline. That's consumer credibility. That's brand validation. That's the kind of slow burn fundamental positioning that doesn't move the chart immediately, but absolutely compounds over time. And then we saw the General Counsel awarded 144,000 RSUs, vesting quarterly through the year in March, June, September, and December. Seems like someone isn't a fan of Santa and is kind of greedy getting them early. You can interpret that however you want, but long-term incentive structures don't exactly scream, "We're worried about next quarter." They scream retention and alignment. So the company narrative is stable to positive. The chart narrative is exhausted. That tension is where opportunity either builds or disappoints. Let's zoom out. On the weekly chart, we closed under the $20.68 Fibonacci level. That's not bullish. That's technical damage. We've also broken through the 50 EMA, currently around $22.04, and we're sitting roughly halfway between that and the 100 EMA below. That's pressure. But here's what's more interesting. For 2 weeks in a row, the weekly low has landed right around $19.10. Not 18, not 17, not cascading lower, the same zone. Meanwhile, the stock RSI is pinned oversold, and the MACD is drifting down toward neutral, but it's losing aggression. This doesn't look like strength. It looks like exhaustion. And exhaustion is how bottoms form, not with fireworks, but with boredom. SoFi's chart right now looks like it tried to be a buy the dip story and accidentally became a dip the buyer documentary. Now zoom into the daily. We broke just below the 200 EMA, which is never a headline you want to read. That level sits around the $23 area, and losing it created the flush we've been living in. But this week, price is attempting to retrace back toward it. Not ripping, not squeezing, just grinding. The MACD has been resplitting slightly throughout the week, but downside momentum isn't expanding. It's stalling, and the stock RSI remains oversold, cycling through the lower ranges without exploding higher yet. In other words, the bears had control. Now they look tired. That's not confirmation of a bottom, but it is the first ingredient. Now let's talk positioning. Expiration is February 20th. Expected move is plus or minus $1.50. Current price is $19.60. Largest put open interest sits at the $19 strike with 41.6 thousand contracts. Right above that, at $23, there are 33.9 thousand put contracts and 20.8 thousand call contracts. Then $25 calls hold 15.6 thousand contracts. $19 is the line in the sand. If that level holds into expiration, there is room for drift higher toward 23. But if 19 breaks decisively, that 41,000 contract wall becomes emotional fuel. Options positioning isn't predicting direction. It's telling you where pain lies. Right now, pain lies at 19 and 23. The weekly chart isn't strong, but it's exhausted. The daily chart isn't collapsing, but it isn't strong either. That combination doesn't scream reversal. It whispers stabilization. This is what early bottom formation looks like. Ugly, slow, questionable. Slightly bullish, but only as long as 19 keeps showing up to work. Now I want your take. Do you trust 19 as a forming base? Or are you hedging in case it's just a temporary pause? And seriously, keep the midweek review or pivot to deeper news breakdown episodes instead? Drop it below. If you enjoy overanalysis, chart psychology, and market sarcasm delivered with just enough realism to keep it dangerous, hit the like button and subscribe. We don't promise price targets. We promise perspective. Remember, bottoms don't ring a bell. They whisper, they frustrate, and they make you doubt yourself right before something changes. And sometimes they don't. That's the market. I'll see you next time on Fintech Spy.